Hello, I'm Blanca Andres, the CFO here at Intercom. I'd like to introduce next Baytex Energy as our next presenter. They've been a longtime presenter at the Oil and Gas Conference, and we appreciate their support on our 25th anniversary. Baytex is Calgary-based and trades on both the Toronto and the New York Stock Exchange under the symbol BTE. Baytex has operations on the Eagleford Shale in Texas, the Peace River oil sands, the Viking light oil play, East Duvernay shale oil play, and the Lloydminster heavy oil play. Around 83% of their production is weighted toward crude and oil gas liquids. Here to tell you more about Baytex is Ed LaFleur, President and CEO.
Well, thank you. It's great to be back at Intercom, even if it's virtual. And before starting, I'm going to go through the advisory remarks on oil and gas information and forward-looking statements. So please have a quick look. First thing I want to say is that our strategy is unchanged since I came in 2016. This is really about reducing debt and deleveraging the company. We moved from 6 times debt to cash flow and 26 times to, at the end of last year, 2 times debt to cash flow, and now we've been hit with COVID. So I will address that and how we're responding. But the first point is we are a very high quality and diversified oil portfolio operating in Texas, Saskatchewan, and Alberta. We have a strong track record of free cash flow generation, and last year we delivered $330 million of free cash flow on $57 WTI. We have good liquidity, financial liquidity, 35% undrawn, so about $300 million. And our first long-term note is not due until June of 2024. And our revolver has been extended until April of 2024. Very consistent and strong risk management approach. We've got some strong hedges that are in place that I'll talk about as I go through the presentation. And we've started to layer in some hedges for 2021, which is pretty exciting. And we're very committed to ESG. I'll say more about that as we move through the presentation. But we set a target to achieve a 30% reduction in emissions intensity, and we're on track to deliver that by, at the end of last year, we were 15% reduced, so halfway to the target, about a year or two early. So I'll keep going and talk about our corporate portfolio just very briefly. We've been listed on the TSX now for 26, 27 years. So we've been a company that's been in Canada for a long period of time. We made a bold entry into the Eagleford in Texas in 2014, and we've been listed on the New York Exchange for some time as well. Market capitalization around $350 to $400 million on any given day lately, with a total EV of $2.35 billion. We have a lot of trading liquidity, so you'll see a bunch of shares trade, about 10 million shares on average per day between the TSX and the New York Exchange. We set guidance for this year and recently updated that to 80,000 barrels a day midpoint production on capital of 275 at the midpoint, and we have reserves of about 530 million barrels. You can see in the pie charts there that we're about 1/3 on production in each of the core jurisdictions I mentioned earlier. The Eagleford, a little greater than 1/3. In Texas, the Viking, a little less than 1/3 in Saskatchewan. And the heavy oil, predominantly in Alberta, but a bit in Saskatchewan, is about 1/3. And then you can see by commodity, we're dominantly in oil. That's what we want to be. It's been a strategic push by the company and continues to be. As we executed the merger with Raging River, we further elevated our oil percentage, and about 3/4 of our business is oil weighted. And then revenue by commodity is light oil dominated, with a mix of about 1/4 heavy oil and then a bit of the natural gas and NGL components. So let me just talk very briefly about environment, social, and governance, ESG. It's the new buzzword, but we've been on this plot now since 2013 when we published our first corporate sustainability report. And it started with safety and spill reductions. And I'm pleased to say many years into this journey, we've had about a 42% reduction in both number of injuries in the company as well as spill volumes. And that's really a critical starting point for any foundation of ESG going forward. So we've also focused on social issues. We've got relationships with indigenous communities and areas. We've signed a deal, recent agreements with the Woodland Cree First Nation and the Peavine Métis settlement up north in and around our Peace River business, which is where Baytex started. And gender diversity is at 25% on the board, and our company is about 40% female. So we're very strongly on focusing on the social issues. And then on GHG emissions, we've just recently got very focused on that aspect of our business. We set a target after our shareholder outreach last summer. We set a target in September of delivering a 30% reduction in emissions intensity by 2021. That's a very short time frame. And by the end of last year, we had already delivered a 15% reduction in GHG emission intensity. So we're very pleased with that. Part of that comes from our nearly 100% routine gas conservation in Peace River, which we started that a couple of years ago. We've built a gas plant in there, and we're collecting and containing all of our gas emissions and fugitive emissions in Peace River, doing our best to do so. So that all contributes to this GHG reduction of 30% by 2021. And we're still, with COVID, more than ever, firmly focused on ESG. The next slide talks about our second quarter earnings or highlights rolled into a first half summary. We just announced that July 29th. Production of 85,500 barrels a day for the first half of the year. Adjusted funds flow of $151 million. It's been a couple of months or a few months now, but it's still incredibly strategic that we issued the US $500 million bond at 8.75%. It was a little higher than what we wanted, but we issued just a couple of days before COVID. So we're very excited to have gotten that done. At the same time, we then redeemed two series of senior unsecured notes, the US $400 million tranche in 2021 and the Canadian $300 million tranche of bonds in 2022. So we retired a whole lot of our outstanding debt at the same time we issued the new debt. And then we extended the maturity of our credit facilities to 2024. So we're termed out to 2024 and then another bond tranche of 2027. We feel good about that. We're maintaining strong liquidity, greater than $300 million. We continue to do so through second quarter, and we expect to generate free cash flow now through the rest of the year and maintain that strong financial position. So let me talk now about COVID and what we're doing. It's an unprecedented challenge. There's no question about that. And the first challenge that we had was protecting the health and safety of our personnel while maintaining our operations. I'm pleased to report we've not had any COVID positive tests in our operation, nor have we had any disruption to our business of any kind. And we took a change in tact on our priorities. We decided at that point in time, far more than maintaining production, we wanted to maintain financial liquidity and focus on that. So we needed to minimize our capital outlays, which we did so aggressively starting in March. And in 2Q, we only spent $10 million as a business, almost entirely in the Eagleford. And then we emphasized cost reductions across our business as well. So what does our liquidity look like then? If that's our number one priority, where are we on it? As I said earlier, we're 35% undrawn. So it's $363 million of undrawn credit capacity. And that net of working capital is about $300 million of true liquidity, net liquidity. We've enhanced our long-term note maturity profile. So you see the graph on the right. We used to have a tranche of 21s and 2022s. Those are now taken out. And we have the 2024s and 2027s coming due, which gives us ample runway to make the strategic and tactical changes and actions to our business. So our credit facilities, just as a reminder, are not borrowing-based facilities and do not require annual or semi-annual reviews of any kind. So then what did we do on the capital front? In really mid-March, we throttled back capital quite substantially, and we announced a new set of guidance. We moved from $500 to $575 million in total annual capital to $260 to $290 million, and that's still our current guidance. We stopped drilling in Canada. We suspended all capital programs essentially in Canada, and we moderated the pace of activity with our operating partner down in the Eagleford, only bringing on 16 to 18 net wells as compared to what we planned previously, which was around 22. And we voluntarily shut in 25,000 barrels a day for the entire period of April and May. And then we started bringing on those barrels in June. And I'm pleased to report now we've got 80% of those shut-in volumes back online. And I would point out on the capital table down in the lower right that we've spent $190 million. So we've only got about $80 million left to go for third quarter and fourth quarter. And that will dominantly be in the Eagleford in Texas. So we're emphasizing cost reductions. We came out a few months ago with a target of 135 million. That was with 25,000 barrels a day shut in. Now bringing back 80% of those volumes, we're estimating that $98 million will be retained as cost reductions across a number of fronts. In G&A, there's about $8 million. Marketing, there's a bit more. Transportation, as we've reduced our production. And then operating expenses are a vast majority of the total. And it's a lot of things. It's a deferral of activity. It's a reduction of various costs, including maintenance and workovers, et cetera. And we're just simply, when wells now break down and they're low, 10 to 30 barrel a day type wells, we are likely not restoring those to production. We'll wait for a better time. So we're not spending money in operations that we would normally spend in a $50 oil environment. So what hedges do we have put on? We felt it was essential to add to our hedge book through July, August, September, and even through the rest of the year. And now we've got, as you can see there, about 16,000 barrels a day on for second half of the year at $38, a fixed price of $38. You can see in the fourth quarter, that's a $43 WTI price. And then a majority of our barrels are on three-way options at 50, 58, 63. So while they look out of the money, we get current WTI price plus $7.50 on every one of those barrels, those 24,500 that we're producing. And the most exciting part about this chart, I believe, is that we put 5,000 barrels a day on for next year on three-way costless collars at $35, $45 floor, and $55 participation to the upside. So anywhere between $35 and $45, we get $45 WTI on our barrels. Anywhere below $35, we get market plus 10. So we like the width of that three-way option and took advantage of that very recently. And you'll see us layering on a bit more as we approach the mid-40s WTI, which will allow us to look at these kind of three-way options with upside that protect the downside as well, and or a combination of swaps. And then on the basis differential for, let's focus on 2021, we've got 4,000 barrels a day on at $14 on the heavy oil differential itself. And then on the light oil differential, MSW is what it's called, we've got about 2,000 barrels on just less than $6. So very pleased with where we are on the risk management front. The asset highlights, I'll just briefly walk through a couple of points here. On the Eagleford, it's been running about 35,000 barrels a day and has been for some time through this downturn of 5 years. 2P reserves of 230 million barrels. But the most important statistic on this chart for Eagleford is the number down in the asset highlights, which shows that we delivered $724 million of asset level free cash flow since 2016. That's a big number, and that's after capital. So that's a net number to benefit our debt reduction and our corporate purposes. In the Viking, similarly, we've been holding flat at about 22,000 barrels a day. It's coming on decline now with where we are in capital spending in Canada. Around 100 million barrels equivalent of reserves. And again, the most important stat on this asset highlights page is that in 2019, the asset was able to deliver $83 million of asset level free cash flow. That's after quite a bit of capital being invested in the asset. So really, really pleased with where we've gotten on light oil. On heavy oil, similarly, 22,000 barrels a day is roughly where we ran first half of the year. 2P reserves of, again, about 100 million barrels of oil equivalent. And it's not stated here, but since I'm talking about free cash flow, and that's what we really care about as a corporation, in 2019, we delivered over $100 million of free cash flow out of the heavy oil business. And we're turning that around this year. We're really throttling back costs more than any other asset in heavy oil. We're trying to reduce our break-even point there such that we can be reinvesting in this asset below $50. And then the Pembina Duvernay, which is our biggest growth area, it's really in its early stages of development, producing about 1,200 barrels a day, about 14 million barrels of reserves. And it's got potential for growth to 20,000 barrels a day. We have an internal plan. We need $50 to $55 oil, but there's enough in the way of acreage. You can see there the number of locations we've de-risked. We do need higher oil prices around that $50 to $55 range. We can really put on a lot of growth in the Duvernay shale, which looks a lot like the Eagleford play to us, and that's the reason we're so excited about it. So let me start with the Eagleford here, and I'll do one slide on each asset. You can see the green is the oil window, the lighter green is the condensate window, and then the pink is the gas. And we're in the black oil, the volatile oil, and the condensate. We're in a very good place in the heart of Karnes County. We've got 20,000 net acres roughly. We're in the 4 AMIs that our operating partner tends to be most active in. We've got roughly averaged for the first half of 2020, 1,750 BOEs a day per well. And we took a frac holiday in second quarter. No activity on our acreage in second quarter and very few drills other than what we did in April. And we're going to be back to work there in the second half of the year. So couldn't be more excited about what this asset has done and what it's intended to do for the future, driving our free cash flow performance as a company. The next slide is Viking Oil. And it's a very large area. It's probably 250 kilometers east to west and another 100 plus kilometers north to south. So it's very large with quite a lot of acreage in good areas in the Viking. It's shallow and it's light oil. It's 36 API oil. Production of 22,200, as I mentioned before. We added 230 net locations through mostly inorganic deals, swaps and optimizations, and outright purchases for somewhere less than about $5 or $10 million last year. So we were able to continue to consolidate the play. Steady pace of development in Q1, then we dropped off activity and we've really stopped activity for the rest of the year. We're sitting on about 30 DUCs in the play, drilled but uncompleted wells. We've got a significant inventory that we believe works at $45 oil. So you'll likely see us coming out with a 2021 plan. that includes this light oil being developed. And that's the Viking. So that's our shallow light oil in Canada. The Peace River is where we started the company, and it's where we're continuing to appraise and grow the company. And I'll get to this in a minute, but we started the company in Harmon Valley. We produced first half of the year with all the shut-ins I talked about, around 11,000 BOEs per day. It's 560 net sections of land, strong capital efficiencies, and we've bolted on two pieces of acreage, one to the north called Golden and one to the south called Peavine. And they're early stage exploratory plays targeting the Clearwater, what we in Canada call the Clearwater, which is the equivalent of the Spirit River collection of formations. And the first activity in the Peavine Métis settlement is, and these are deals done with First Nations groups, and it's a real benefit to them. It's a benefit to us. We employ a lot of First Nations people in our business. The Indigenous communities are very important up in this area and in our Lloydminster business. But the first activity in these areas is going to have to wait until early 21. We need about a $50 oil price to start getting pretty active again back in this area. So we built our company here, and we plan to continue to invest in the heavy oil in Peace River. And Lloydminster, it's a lot like the Viking, but it's a bit more north-south. It's 300 kilometers north to south and quite wide, quite a broad land base. And the core areas are listed in the names you can read yourself. We produced about 11,200 BOEs a day in the first half. Strong capital efficiencies. Again, we're applying multilateral technology to produce cold flow heavy oil similar to Peace River. And we've ramped up our Carrabber, the further southern asset thermal project. It's a SAGD project, and it peaked in Q4 2019 with about 3,500 BOEs a day. We have curtailed that production somewhat this year due to the low prices, but we continue to operate it. We're very excited about this area. And again, we believe at $45 oil price, we have the opportunity to invest in this area because the capital efficiencies are so strong. So look for that in 2021 as well. And then the Pembina Duvernay, I've already talked about it. It's 275 sections of land. 125 of those sections we believe are de-risked, anywhere from 4 to 6 wells per section. It's hundreds of wells of potential for us. We're only producing 1,300 BOEs a day in the play today from 9 wells. I believe 7 are producing today. And we drilled 2 wells in the first quarter of this year, and they're yet to be completed, and we're contemplating completing those on the red star there you see on the map. In the core of in the heart of our play, right at the crossover between the volatile oil window and the black oil window further to the east. And we're contemplating fracking those wells at the end of this year, mostly because they're so important to the strategic agenda in the area, and further demonstrating our cost structure of $7 to $7.5 million per well, drilled, completed, and tied in, and the production rate of about 1,300 BOEs a day per well, which we delivered on a single well last year. Our first 2 wells last year averaged about 1,000 barrels, 1,050 barrels a day per well. But we're fairly confident now with the type of frac technology we're using that we can deliver the 1,300 BOEs a day per well. Potential to grow this asset tenfold or more. As I mentioned at the outset, it's a big growth area. There are quite a number of public companies and private companies in the area. I think we'll see some consolidation here over the next year or two, and we're excited to be one of the larger public companies in the play. So that will wrap it up for me. The summary is we're all about free cash flow this year and managing through the COVID crisis and delivering debt reduction to all of our stakeholders. Thank you very much for the time.
Thank you, Ed. I'm Blanca Andrus with Enercom, and I'll be conducting the Q&A for Baytex today. So please write in your questions, and Ed will answer them. And we're good. So there's one. So our first question is, ESG is a hot topic. Can you discuss your ESG efforts?
Sure, this is Ed LaFair, and good to see everybody virtually. But yes, we've taken on ESG in a very big way, starting in 2013. And the thing we did this year that was different than our prior years was we added a 30% reduction in GHG emissions intensity by 2021. So it's a very short space in time that we've taken this objective on. And I'm happy to report that as the end of 2Q, we announced by the end of 2019, we were halfway to the target. So that's the big new addition. We've also got some deals with indigenous groups, investing heavily in the First Nations communities up in Canada. We have good board diversity and board independence, and we've been focusing on all aspects of ESG, not just GHG emissions reductions.
One more, Ed. You talked about your philosophy to deliver free cash flow in your business, which has been pretty impressive for a number of years, and you even delivered a positive free cash flow during the second quarter. As you look to deliver free cash flow in the second half of this year, remind us of your potential uses of this free cash flow and where your priorities lie.
Right. Well, last year we delivered $330 million of free cash flow, and it went to repaying debt and also investing in our principal assets as well. So in 2Q, things were very different with COVID as we ratcheted capital back to $10 million, and we generated about $18 million of adjusted funds flow. So we had $6 million of true free cash flow. And second half of the year, I'm pleased to report, will be much higher than that and will give us free cash flow through the full year. And the principal component of that debt, of the free cash flow, will be to pay down debt. If we find ourselves in a $50 world, then we might think about increasing our capital, but we're not going to increase our capital above the guidance range that I talked about, which was $260 to $290 million. We're just simply going to stay with capital discipline, maybe even point to the low end of that capital range and hold the brakes on capital so we can put that free cash flow to our liquidity and ensure we maintain greater than $300 million of liquidity, which is readily doable. We're at that point now and prices have improved. So we'll increase our liquidity moving in towards the end of the year.
One more question. The US dollar is weakening. Can you talk about how this helps you operate, generate returns in the US versus Canada?
Well, we have a natural hedge on with respect to the foreign exchange rate between the US and Canada, because we have a large operating business with both costs and revenues in Texas. And we have a large operating business in Canada with costs and significant revenues in Canada. So we take the approach not to hedge the foreign exchange rate, but we do hedge the commodity, and we choose to invest in our best assets. So I think where the FX rate is today doesn't really change how we choose to invest in our properties. Our first call on capital is always going to be the Eagleford in Texas, and it continues to be, so we're investing there. But very closely on the heels of that are some quality investment opportunities in the light oil in Canada, in Saskatchewan, and the heavy oil properties we have. But as I said earlier, we're not going to invest in Canada until we see an oil price that's probably between $45 and $50. We may do a few selective small things, but no change in our capital allocation philosophy and investment philosophy or uses of proceeds based on the small movements we see in the foreign exchange rate.
Ed and Rod, can you get into detail about how your oil field service vendors are costing out your drilling and competition costs? And will you be able to lock in OFS costs, or will this be a well by well decision?
Well, in Canada, we're not operating any drilling or completions today, although we're potentially going to move into frac 2 Duvernay wells that we have that are already drilled but uncompleted. We're seeing oil field services costs down slightly, I would say, in Canada from an all-time low. So this is a good thing and a bad thing. The good news is the cost structure is very, very strong. The bad news is that we need a healthy oil field services group that are supporting us with top flight teams, top flight equipment, and top flight capability. So that's what we're working towards on the Duvernay fracs if we choose to go ahead with that. And then the question is more of one for 2021. In the Eagleford, we're seeing cost reductions, and our drill, complete, and tie-in costs are running about $5 million. And I think previously, a year ago, they would have been about $500,000 higher than that. So we're seeing, I would say, deflation in both of our jurisdictions, north of the border and south of the border.
Let's see. What's the WTI price you required to deliver a sustaining CapEx budget for 2021? And along the same lines, have you seen any change or improvement in your capital efficiencies and decline rates, which will impact your sustaining CapEx in the future?
Yeah, I think for 2021, we'll get to that point where we announce the budget in December. We work at September through November, but $45 WTI looks like the point at our exit rate of about 75,000 barrels a day, where we expect to be able to hold production flat and deliver cash neutrality, which means we would be $300 to $350 million in cash flow and $300 to $350 million in capital, and we'd hold the business flat at $45. Anything in excess of 45, we would probably move towards the balance sheet or our liquidity. And part of the reason we can do that is because the decline rates have reduced, even though we'd be investing a lot less capital. Last year, we were running decline rates corporately of about 33%. And this year, because of the smaller wedge of new production with high declines, our decline rate is moderated down to about 28%. So, you know, low 30s down to high 20s matters on a production size and scale that we have.
How is your capital expenditures and timing aligned with your WI partners? And what improvements are being implemented in the Eagleford completions, providing the positive results shared?
Yeah, with our operator in Texas, we've had strong alignment over the last 5+ years. So whether we were in a growth phase in 2014, which was before my time, we went toe to toe with the operator to fund growth in the Eagleford. Then when 2016 hit, in a $30 to $50 world, we throttled back capital. We agreed fully with the operator to move capital down. And then in about 2017, 2018, we and the operator shifted to a significant free cash model where we have agreed to hold the business flat at around mid-30s, 30,000 barrels a day, working interest barrels a day production, and to generate as much free cash flow as we possibly could, which required cost efficiencies, capital efficiencies to be better. Everything in the business had to get better in order to continue to drive free cash flow. And in those 2 years, 2018 and 2019, we delivered about $500 million Canadian dollars in free cash flow above capital in those assets. That was over a 2-year period. This is one of the biggest free cash flow generating assets that we've seen around the business, and we're in the center of Karnes County in the Eagleford, Texas. So we just couldn't be happier with not only the asset, but also the alignment we have with the operator.
Can you elaborate for us how your corporate culture has evolved or changed during the COVID-19 crisis? And how has your work from home strategy played out for staff? And is this leading to some new thoughts on how you approach the business?
Yeah, probably. It's a good question. A lot like this conference, we're evolving and growing and learning as we go. Um, Sometimes not all the technology works perfectly, but this is a phenomenal new way of working where our executive team, our board team, our teams planning and replanning and determining quality of assets and bringing through recommendations to management has all changed fundamentally. How they're working together as teams and how they're bringing recommendations to ourselves. But I couldn't be happier with the IT technology, the collaboration software that people are using. We've all had to learn, even us old dogs have had to learn some new tricks and new skills, and it's working very, very well. It's unlikely. We've got 4 office floors in Calgary, and maybe we've formed a new team, a committee, a working committee that's looking at all the new ways of working that could set the new normal for Baytex in the future. And it could mean we have a lot less downtown office space and we have a lot more virtual working. It means a lot around hygiene and etiquette. And when we do have face-to-face meetings, exactly how that works. But everything's changing. We've decided we're going to develop a new approach to working, and we don't know what that is yet, but we're evolving and learning and growing as time progresses.
Well, Ed, I think we're running out of time, but thank you very much for your support, and especially on our 25th anniversary. We had a different idea, but thank you so much for being a presenter with us, and I hope you enjoy the rest of the conference.
Okay, thank you, Blanca. Thank you very much to Entercom for putting this on.